Well, I think in general, we're shifting towards a more multipolar world. If you looked at, gold as a percentage of sovereign reserves, for example, or just even just the number of tons they have, they were on this like structural decline from like the 70s until like 2008. Basically, you had rising dollar dominance and you had falling gold dominance. And after 2008, when we basically just printed the difference, like when our bank system blew up and we just printed, you started to see this like reversal, and foreign central banks started buying more gold again. And they've actually kind of gotten back up to like, significantly pre 2008 levels. So that was like one factor. Number two is you had China Belt and Road Initiative. When they launched that, it was something like 2013. They basically came out with an announcement, and they just said like accumulating treasuries is no longer in our national interest. And so what they started to do instead was take a page from the European and American playbook of like monetary, like neocolonialism, where they say, okay, we're going to start, instead of like taking all of our dollar surpluses from the trade surpluses we're running with the Americans, instead of like putting all those dollars back into US assets, we're going to start making dollar loans to African countries, Latin American countries, Central Asian countries, basically help them build infrastructure that kind of all leads to China, buying commodity rights, that kind of thing. If they default on any of that debt, basically some of those rights go over to China. And so they've kind of tied themselves into this global euro dollar market to a significant degree instead of buying treasuries. And Saudi Arabia, instead of just constantly taking their petrodollars and putting them into treasuries, they're putting things into like, their sovereign wealth fund, kind of these, for a while they were really into these big tech growth type of stocks. They're doing domestic development. They're doing all sorts of partnerships. And so basically a lot of these countries are saying, instead of just this current system that was in place for decades, we're going to start investing our dollars elsewhere, at least around the margins. So it's not like we're dumping all of our treasuries tomorrow, but it's like we're just not going to keep accumulating our stockpile and might even trim our stockpile like China's done. And so I do think we're shifting towards a more multipolar world. There's obviously challenges there. I mean, one, they can settle in gold, but they still have all these like payment centralization issues. And so you see them working on like, what is it, Enbridge or something, where they're basically they have like this like blockchain thing they're working on with the BIS to see if they can like settle things outside of SWIFT. All these alternative payment systems. Russia has theirs, China has theirs. Some of these collaborations. And there's ongoing frictions there, but I do think a general trend is there's a pretty adamant shift towards, with the combination of more multipolar payments and more multipolar reserve assets. Instead of just dollars, it could be gold, could be yuan, it could be others. If Bitcoin gets big enough, that gets interesting, but it's not, right now at the size it is, they're not really, it's more about gold and currencies and, equity types of investments. And I think that's the general trend we're on, is that more multipolar. But it's funny because there's weird frictions. Like, for example, India is another country that has kind of broken out of the Western consensus. And they said, well, I mean, we're going to basically buy all the spare Russian oil then, right? Because then they literally said it. They said, look what's happening to Sri Lanka. We're not going to have that happen here. So we're going to buy whoever is going to sell us oil the cheapest. So India started buying a ton of Russian oil, and they already had plans in place to expand trade with Russia anyway. And one of India's goals was to buy oil in rupees. And that was promising for a while, but the problem is now they're actually buying so much Russian oil, and Russia doesn't want that many rupees. Basically, India's running a pretty big trade deficit with Russia. And so that actually creates like a settlement problem. And so there's always these like weird frictions they run into when they're trying to have like this big fiat barter system we essentially have in place. We have 180 different fiat currencies, and whenever they're trying to do global trade, it's kind of a nightmare for them to work through, and it's a slow process. And that's why the path dependence is challenging here, because raising rates can reduce, demand and inflation pressures in the real estate market, right? Because they use debt so heavily. It also is having a big impact on unprofitable tech companies, because they've been very reliant on structurally high equity valuations and constantly issuing new equity in lieu of profitability. Obviously, that's fine for startups, but if you're a mature company and that's like your perpetual business model, that's malinvestment. That's a problem, and a lot of that's being cleared out right now, because in higher rates, kind of like how real estate gets hit, that unprofitable high equity focused tech gets hit, because then it compounds on itself, because then you realize, okay, now that they have to raise prices to make up for the fact that they're not able to constantly issue as much high value equity, and when they raise prices, their growth rates go down because their growth rates were only at the level they were because of artificially low pricing due to not having a mandate to be profitable. And so real estate and tech are the two areas that are adding some degree of disinflation to the mix. I think going forward, because you're going to have in some ways stagnant prices, you're going to have less overall activity in those areas, and I think the Fed's basically hoping that that's enough to counterbalance a lot of the other inflationary forces, which are energy, which are labor shortages among people who make stuff and maintain stuff, and the fiscal-driven inflation. And so I think we're in this awkward phase, like now, maybe the next year, where those two forces, it's kind of hard to say which one's going to win over like a 12-month period. That's why it's, I think we still could get this period of disinflation ahead. But then when you look out, 24 months or 3 to 5 years, I think certainly those inflationary forces are stronger and can override some of the tightening that they can do in some of the most interest rate sensitive industries. And when that happens, I think you get a trend shift in psychology. I think you get big questions around Fed independence and politicization of Fed activity. And I think actually one of the things that challenges that is we're about a week or two away from the Fed having negative tangible equity, which is interesting because now they're operating at a loss, and they've been operating a loss since September, and those losses have now piled up such that they are about to equal their existing equity. And so that's going to start raising independence questions, and it gives certain congressmen that don't like what the Fed's doing another avenue to kind of go after them.